Hello, everyone. Good morning, and welcome to our morning market update for Monday, December the 18th of 2017. This is George Papazov for TRADEPRO Academy. Today is the first day of the last week, the last full trading week of the year. Let me just check if the audio is working. I want to make sure. Yeah, it is. All right. I have this paranoia sometimes the mic's not working because it's happened before. All right, today's the first day of the last full trading week within 2017, and that means it's time for the Santa Claus rally. You're gonna laugh at me, but the reason I was late is I have this Santa Claus hat somewhere in my wardrobe over there, and I figured I'd find it and use it. Didn't work out. Obviously, I'm not wearing one, unless I can hypnotize you to believe that I am, and then it's a whole different story. But that'll take too long. Today we're going to talk about the Santa Claus rally. We're going to talk about oil prices and why they're up a little bit this morning and what we think is going to happen for the rest of the month and going into January. And then we're going to talk about the new Bitcoin futures from CBOE or CME, Chicago Mercantile Exchange. Then we'll end it there. All right, first let's take a tour around the marketplace and start out in Asia. So Japan finished the session up 1.6%. Huge rally, huge. Hong Kong's up 0.7%. China's up 0.5%, and India's up 0.4%. Lots of longs, lots of upside momentum in Asia. Did that move over to the European session? Yes, it certainly did. London was up 0.4%. Paris was up 1.2%. Frankfurt up 1.5%. Strong markets out of Europe as well. Did that spill over into the United States, you might ask? Well, yes, it did. Dow Jones is up 0.5%. S&P's up 0.3%. NASDAQ's up 0.6%. Crude oil's up 0.5%, and gold's even up 0.3 percentage point. So everything this morning is pretty much green except for Bitcoin, which is down 0.1 percentage point, which Bitcoin could erase in a matter of nanoseconds and move $4,000 up to the upside. So you never know what to expect with that. But the point I'm trying to make is there's a lot of longs and a lot of traders getting long. Now, typically this would mean, hey, be careful going into the European close. There might be a little bit of selling, and there very well may be. So watch out for about 10:45 to 11:30. Data shows that when Asian markets are long and European markets are long, we tend to get a pullback or a sell-off into the European close for some profit taking. So we'll definitely be looking for that trade today. However, the greater thing at play here is the Santa Claus rally. Okay, so what the Santa Claus rally basically is that Santa goes up in his sleigh and then drops a couple percentage points inside of your account. No, I'm kidding. That's not what happened. Something dropped. I had to check for fear of my safety here in the office. All right, so the Santa Claus rally occurs in the last week of December through the first couple of days of January. There's some more valid reasons for it and a little bit more psychological, less valid reasons that I don't know if I completely 100% agree with, but let's go through them. Some of the ones that are a little bit more valid from an institutional standpoint is that funds are high closing their book, or it's called mark to market or marking high. And what that means is if you have a performance of, let's say, 2% and you know the market's going to go up and you have some cash on the sideline, what are you going to do? You're going to dump that cash into the long side of the trade to try to catch some of that upside appreciation in the last couple of days. So it's a little bit of a self-fulfilling prophecy that institutional traders and mostly mutual fund companies tend to chase that higher close and high mark their book. What's spending a couple million of dollars buying S&P 500 futures if that close could lead to a 2% return for your fund? It's nothing, right? That's a couple $1 million well spent. And I know that doesn't make sense to some traders because they're thinking on a smaller basis, but that's just the reality of it, and that's what causes some more buying. So look for a strong bid right into the close on the last day of the current year, and look for the new year to open a little bit strong for the first 1 to 2 sessions, and look for the dump because it's coming. All right. That's one reason. The other reason is quarter-end mutual fund rebalancing. So mutual funds have this thing where they have to rebalance their portfolios, all right, which leads to especially this one aspect of it called something called window dressing. What that means is you take some salad dressing, you spray it on your window. No, what you do is you basically go in there and you're buying strong stocks. Why? Well, because your investors are going to say, hey, I have a mutual fund. Let me look at the quarter end statement and let's see if they own the strong stock. So you could go brag to your friends, hey, yeah, I own that while it was going up. But what mutual funds do is, let's say a stock like Amazon has been on fire, and it has been. What a mutual fund will do is they'll buy Amazon if they already don't own it, which good chance they already do. Most institutional funds and most mutual funds own a large amount of FANG stocks, but they'll buy Amazon. So when the statement gets sent to the client, it says they own Amazon in that quarter. Doesn't tell you when. It just says you own Amazon. Here's your top 10 holdings. And it looks like, wow, this is great. My mutual fund manager knows what he's doing because he's buying the strong, or he had the strong stocks, but they don't know that he's buying them after they've already appeared to be strong. And they sell the weak ones because nobody wants to look at their statement and say, hey, look, I own this loser. Nobody wants that. So that's what window dressing is. Selling the weak ones, buying the strong ones. That, in effect, becomes a self-fulfilling prophecy as well. So that's also part of the Santa Claus rally, or the year-end effect, that we experience here in the stock market. And then last but not least, short sellers also have to close their book out, and they have to buy back their shorts. So short squeezes typically happen the last time, right into the end of the new year, as shorts have to chase their stops to get out of the close. Traders know that they're stuck. The more shorts there is, the more exaggerated this effect is. This year, there isn't as many shorts. We've just squeezed the heck out of them since the beginning of the year. All right, so, and we squeezed a lot of the shorts from the quad witch of this past Friday. That's where a lot of the short sellers had to get out because they probably shorted the December contract. Okay, and there's some more kind of psychological ones that seem a little bit more far-fetched, like general happiness and optimism around the holidays because of the Christmas spirit. It's not far-fetched, but this next one especially, I think, is far-fetched. Christmas bonuses getting reinvested back into the market. I don't know about you guys, but when I worked the 9 to 5, that's not what I experienced. I experienced people spending the money and saying, "Wow, I can't wait for my Christmas bonus." Why? What do you plan? How do you plan to invest it? Invest it. I'm planning to pay my credit card off. Oh man, my bonus is less than I expected. How am I going to pay this credit card off? That's what I remember hearing. I don't know. Maybe it's changed. Maybe people are actually investing with their Christmas bonuses. Doubt it. But maybe. Here's for hope. Also, another theory is that the Grinch stays away from Christmas, right? They try to spoil Christmas, but most traders that are Grinches stay away from it, and lack of negative, or lack of the ability to short, actually gives it a little bit more of a bullish sentiment. So that's another one that's kind of out there. Those are my observations. That's kind of what leads to the Santa Claus rally. It's happening right now, and it's about 1.1 to 1.3% on average from holding it from the beginning of the last week of the year, second day of January. Okay, and then be careful because then it starts to drop off. All right, I don't really have too much time to talk about anything else, but I really thoroughly destroyed the topic of Santa Claus rallies. Oil prices this morning are going up. Nigeria oil unions launched a nationwide strike. All right, with some stalled negotiations with government agencies. So that's a little bit of an upside bid in oil prices. The price rise also follows last week's news that the North Sea 40s pipeline has been shut down for repairs. And also last Friday, we had a Baker Hughes report showing a really large decline in the number of offshore drilling rigs in the United States. All that led for a little bit of bullish sentiment oil. I still think we hit oil and we ride it to the downside. Use this rally as an opportunity to short into it. That's what I'll be doing. And last but not least, Bitcoin futures made their grand and massive debut last night. I was watching them in real time. The first 15 minutes, I think we had something like 70 contracts traded. There's absolutely no liquidity on these Bitcoin futures. Nobody's trading them. Let's see what happens on the open. But it looks like a bust so far, right? We're supposed to get all this institutional volume. Yeah, I know it's not even the first U.S. Open yet after they've been launched. But the difference between CME and the CBOE futures, CME is 5 Bitcoins for each one contract. You can see institutional traders desire bigger positions, bigger contracts, because they need to purchase in bigger size, whereas the CME is a little bit more retail focused, where it's for 1 Bitcoin. CBOE is the one that came out last Sunday. CME is the one that came out this past Sunday. This is the one that most institutional traders look for. It's for 5 Bitcoin, like I just said, the CME, and the margin's 35% times 5. Do the math, right? 150%. So one contract, the CME is going to cost you about $24,000 US. And now you know why there's absolutely no liquidity. Who's going to trade that futures contract? Most people that want to buy Bitcoin have $500 and are trying to make it into 10 million. So that's not the product for them. So they're looking for something different. I'll keep an eye on it. If it's tradable, we trade it. If it's not, we move forward with our life and we continue to trade the same patterns that make us consistent profit without exposing our account to that enormous risk. And at the end of the day, that's a trade like a trade pro. All right, guys, enjoy your last week. We're going to keep going here every single day. We got a morning market update, and including next week, we have some good updates coming your way. So if you have any questions, pop in the comment box. I hope you enjoyed learning about the Santa Claus rally today. Now I've got to do my patented chair spin, turn around and open the trading room, set some levels, and trade live for today. Squeeze out some profit. Another day, living the dream. Okay, you guys take care. Have yourselves a great day. I'll catch up with you tomorrow. Chair spin in 3, 2, 1. Adios. Goodbye. Adios. All right, trade pros, let's do this. Let's get down to business. We're going to make money this week because it's another week.